Good morning, good afternoon, good evening. Welcome to Late Night Learning. I'm your host, Dr. Anthony Palomba. Now, today we're going to be continuing our discussion on media finance and mergers and acquisitions. And so in the last lecture, we really talked about assets, we talked about particular costs, and really one thing I want you to pull away from that lecture is it's difficult to value any kind of media or entertainment property. It's easy to look at the history of one thing, but it's also difficult to know if it will blow up. Case in point, the show Riverdale on CW. Now, when Riverdale first came out on CW, it really didn't do much of anything. It was kind of a quiet hit among niche fans, niche audience members. But it went up several 100% when it was featured on Netflix because it happened to find more audiences. And so all of a sudden, the show became wildly popular and wildly valuable. But this came really because of shrewd happenstance. It was shrewd on the part of CW to offer Netflix a license to exhibit Riverdale just for the sake of grabbing more eyeballs, and it worked. And other TV channels have also fallen in line and done the same thing, although I do think in the future it'll be smaller channels and less attended to channels that will be doing this. As we can see, NBC, Disney, and some of the big entertainment juggernauts have pulled their content out accordingly. And on that notion, let's get started. And so when we think about what media firms focus on, operating cash flow is a very, very important measurement here. Earnings before interest, taxes, depreciation, and amortization. And as we know, the entertainment industry is very unpredictable. It is wildly volatile, and it is really subject to a lot of external factors that some other industries are not. People will continue to purchase homes every summer, at least for the foreseeable future. Weather will likely not impact this. New homes will likely not impact this. But with weather, with different kinds of content coming out, with different kinds of producers and directors rising to the top each year, the entertainment and media industries are highly unpredictable. And so operating cash flow is very, very important because there's always a risk in trying to ascertain an audience. Note that. There's always a risk when you're going after an audience. And so EBITDA, if you will, is a measure that allows for focus on film aggregate performance rather than finances, taxes, or accounting. And so it really is a way to know how we're doing before we think about interest, taxes, depreciation, and amortization. And it does specifically look at the cash flow rather than the revenue. And so in media, the net income or profit from a firm is paramount here as well. And so net income, which comes right at the end after gross revenue, after net revenue, and then income itself. And so EBITDA, if you will, is very, very important to have and possess here. This is an appropriate profitability measure for a company whose capital-intensive assets are going to be around for a while. Arguably, it may be a poor measure for a company in a rapidly changing industry. However, entertainment and media firms still tend to focus on this because they want to illustrate and demonstrate longevity to shareholders, right? Even though the media and entertainment industry is unpredictable, I still want to convince all of you fine people to invest in Disney. I still want to convince all of you fine people that Warner Brothers is stable, or as stable as possible, or as stable as much as I can convince any of you that it is. And so most firms also are subject to first copy costs. There is only one cost or upfront cost to creating a newspaper or a television show. Really, the first time you have to purchase a studio or erect a studio or purchase cameras for the entire season. These upfront costs, otherwise known as fixed costs, are necessary. And really what inflates costs for entertainment and media, usually more so than anything else, even including actor salary or producer salary or director salary is the cost in marketing. My goodness. Marketing continues to go up exponentially in the media and entertainment industries. If there is nothing else you take away from this slide, marketing costs continue to rise through the roof, really across all entertainment industries. Now, why would that be the case? Why is marketing going up? Well, each year we have about 500 television shows across TV networks, cable channels, and SVOD services. Do you have to pay more to get people's attention? Yes, of course you do. It becomes more expensive to buy up more media time to advertise for the next Honey Boo Boo spinoff, or the next My 600-Pound Life, or the next Dr. Pimple. Yes, that is a show. And so when we think about how difficult it is to find an audience and to bring them somewhere, and we already recognize the audience is going to be fragmented, firms are really in a bit of a pickle when it comes to rising market costs. And so they have to find ways to reduce those costs. And one way in doing so is really finding audiences that are more inclined to view content than those who are not. Let's move along. EBITDA continued, and I know that this is a strange word. It is useful in mature industries, including the newspaper, broadcasting, and cable industries. It is a useful measurement, especially since it allows media companies to include interest on capital to build tech infrastructures. So it includes interest, it includes everything that's being spent for media firms to continue to prosper. And that's why this measurement is also useful. The media and entertainment industries are kind of always in a state of building, right? I'm looking at 7 scripts right now. There are 7 scripts that are currently greenlit and are going to go into production. And then I have 7 movies that are now being exhibited in the next 4 years. Does everybody see that? There are always things that are moving in a particular industry. And so it's useful in mature industries because it can help set a foundation for what's going on now and how we're building toward the future. And these mature industries tend to be stable. That's another important connection to make here. A mature industry is a stable industry. A mature industry is a stable industry. Now, there's always going to be some volatility, but by and large, they're stabilized. The newspaper, broadcasting, and cable TV, yes, there are things that go on, but those industries are mature, right? We've had the New York Times for some 150 years. The LA Times we've had for over a century, right? We know the news industry is pretty stable. Fox, NBC, CBS, and ABC, right? Those 4 together, we've had since about 1987, 1989, when Fox came into the foray. Previous to that, ABC, CBS, and NBC were hanging out during the 40s, 50s, and 60s into the 70s. And cable television has largely been stabilized over the last 20 years or so. And really, we've had Nickelodeon, we've had MTV, we've had a lot of these cable channels, legacy cable channels, since the early to mid 80s. And so this is and continues to be a useful measurement because it aids us in getting a better sense of what's going on with these media firms. And so it also allows us to understand depreciation and amortization, such as cable networks or broadcast licenses to operate income. And so it also allows us to get a better sense of what is depreciating over time. What is the cost structure in exploiting Rugrats, the Nickelodeon cartoon show from the 1990s, today, in 5 years, and in 10 years, right? That deals with amortization. Hence, media companies traditionally focus on maximizing EBITDA rather than net income and maximizing the performance of assets based on generated cash flow. Because again, cash flow is positive and it can help raise the stock price. And additionally, EBITDA helps us as media conglomerates illustrate that we're investing in equipment, we have intellectual property that is currently being exploited, And we also have content that's finished that is currently being marketed. And so when we're able to show that to our shareholders, we are able to have a higher stock price. Let's move along. Asset value maximization deals with a way in which that we may look at KPI rather than profits. So some assets, film libraries, recently CBS purchased what film studio? Lionsgate, right? And Lionsgate has the Saw series, among other things, the horror series. CBS purchases Lionsgate. And so these assets represent long-term assets that will hopefully generate future cash flow, because future cash flow is vital, again, to raising our stock price. And so the focus is built on building assets that will generate cash flow over a long period of time, rather than focusing on cash flow in the immediate year. If Sharona or Aaron or Anicia create a Bravo TV show, let's say the Real Housewives of Queens, or maybe another Top Chef in Queens, right? I'm just trying to think of some shows on Bravo. If that's the case, those ladies are not creating a show for now, not if they're smart, and they are smart. So they are creating an asset that they hope to continue to exploit in the future, right? Producers of a particular show usually don't make a ton of money until the show is in syndication. That means it is airing elsewhere. That means no more new episodes are going on. Bravo is no longer airing Top Chef Queens, and the ladies never sold the rights to the show to the channel. And so the ladies now, if they want to license it to the USA Network, if they want to license it to TNT, they can charge a fee. And so value here is determined on the value of breakup. In other words, the private market value, or what a firm would pay for the firm's assets. What would Warner Brothers pay for a Disney cartoon library? Again, we can't compare the Disney cartoon library to the Warner Brothers cartoon library with Bugs Bunny and Daffy Duck. It's kind of difficult to do that. How do you compare the two? So that's the value of breakup. What that means is the asset is considered alone, and the firm who's interested in making the purchase for the asset has to figure out how much it's worth on its own. And it may look at audience ratings, it may look at sales data, it may look at advertiser ROI, what advertisers have recouped from advertisements displayed on this particular show. So there are certainly ways in which we can figure out the value, but it is a very tall task. Let's move along. Cash flow. I alluded to this earlier, and I've mentioned it several times. I just want to be sure that we're clear on this. A cash flow statement is only concerned about cash coming in and coming out. A cash flow will let you know, Jenna and Jordan's film company, Red Storm Pictures, brought in $10 million this month, but it also gave out or paid out $5 million. That's what a cash flow statement will tell you. It doesn't consider borrowed credit or really anything else. What kind of cash is coming into our firm and what's leaving us? What's leaving us? And so it helps summarize source and use of cash flow in an operation and considers the beginning and ending cash balances. What did we begin with October 1st, Jordan? And what did we end with October 31st, Jenna? That's what we're interested in a particular cash flow situation. Now, cash flow may come from operating activities, investment activities, and flows from financing. If we think of a TV studio, or if we think of a TV network, let's say we're thinking of Fox, Fox may have retransmissions fees that it's paid to from DirecTV, right? DirecTV or Time Warner pays for the privilege to exhibit Fox, right? We know that cable systems and satellite systems pay ESPN for the privilege of distributing their channel. And so Fox or an ESPN may gain money from that, and they also gain money from advertisers, making purchases for media time. And so cash flow may come from all of these different things. It is influenced by cash, accounts receivable, and prepaid expenses. And so this is very, very useful if you're looking at your particular budget and you're saying to yourself, I don't know if we can afford to make another Mission Impossible. If you're a film studio, right? You might want to think about how you're going to justify this particular investment. You might look at a balancing sheet and say to yourself, well, we have 50 million coming in. Maybe we can invest 15 million cash into the movie that we don't have to borrow. And then maybe I'll bring in Paramount Pictures as a co-distributor. And so they can finance the production, and then they can have the rights to distribute the movie, perhaps in Europe or perhaps somewhere else. And so these kinds of deals and negotiations do go on. And the next time you watch a movie, see who the production companies are. The more production companies that are involved, chances are the more production companies who are investing in the project to spread risk. Let's move along. Achieving long-term growth and debt. Analyzing investment and finances, projecting future consequences, deciding what alternatives to take, measuring performance. Ultimately, all of these items suggest one thing. How much debt do we take on? Who here is in debt? Myself included, don't worry about it. Debt is something we need to take on as people. We always need to face some sort of debt because we're hoping to pay it off in the future to be better. Debt has allowed for social mobility, for firm growth and maturation, and it's also allowed for innovation. And so when we think about debt and we think about taking on debt, there is something called good debt. A financier may say that taking out loans for school and purchasing a home are both elements of good debt. But when you're an entertainment or media studio, you really do have to think about, what am I investing in and what are my finances? What do I know I'm going to be getting back? We know that with the movie industry, 80% roughly, do not make back their investments in the movie industry. And in order to really make back your costs for a movie, you need to make 2 to 3 times more what your costs were. So, if I make a superhero movie for $100 million, I better be getting back 200 to 300 million. I need to pay theaters, I need to pay for marketing, I need to pay for other items as well. And not all movies do that. Rom-coms, generally, do not make 2 to 3 times or 2 to 4 times what their costs are. It can be very difficult to do that, although there are, of course, exceptions. Projecting future consequences has become more scientific in the entertainment and media industries. Statistical modeling and other things that can be run help reduce risk. But it's not easy to know what's going to do well and what won't do well. Deciding what alternatives to take is also something that is absolutely crucial to the longevity of your media studio. And how do we measure performance? We have this really cute character, Aldo the Wizard, and he is just amazing. My goodness, Tashi did such a great job with Pietra in designing this character. The ladies did such a good job. And Alec, oh my goodness, Alec colored it well. And the character looks great. But if the movie doesn't do well, is it their fault? How do I measure the performance of my animators, Tashi, Pietra, and Alec? How do I measure their performance? And then ultimately, when I consider all of these parameters, how much debt do we take on? Hopefully some of you feel a tinge or a pinch of nervousness. The entertainment and media industries are not for the faint of heart. This is difficult to understand what to invest in. Difficult to find what a sure bet is. Let's move along. So, how much debt are media companies in? I was fortunate to find this. I believe Variety had this. One of the Hollywood trade publications had this. Moody's Investor Service is something for all of you to follow. It will let you know debt, finance ratios that you may be interested in, earnings per share, profit, earnings ratio, all of those things. It's very, very good on that. And so how much debt are the media companies in? The debt bet. And I'll read the top and I'll go over what you're looking at right now. The largest media companies have loaded up on short and long-term borrowings thanks to low interest rates and easy access to credit. We know after the recession, we've had a really, really great period of economic growth through the Obama administration and into the Trump administration. Regardless of what you think of the gentleman, we've been doing quite well over the last 5 to 7 years. But we do have a boom and bust economy. We go through periods of recession. We go through periods of growth. We all know this. And so when we look at this chart, we also have to recognize if these firms are setting themselves up for something dire. Now, in red, we have debt in billions, and then in black, we have debt to earnings ratio. Debt to earnings ratio. How much debt for every dollar of earning, if you will? So for AT&T, it has $183 billion in debt. Billion with a B, ladies and gentlemen. All of the red is billion with a B. Its debt to earnings ratio is $3.7 for every dollar earned. That's pretty crazy. 3.7 times more debt than earning. You can look at Comcast, $114.7 billion with a B in debt. Remember, Comcast is unified with NBC Universal Television, and film is also under its auspices. And as we move down, we can see Disney, see a few others. Who has the highest debt to earnings ratio? Netflix. Netflix has about $7 of debt for every dollar earned. Just about. And Netflix's model has long since been every dollar raised for subscribers is meant to help pay off or meet another billion in debt. And so Netflix here has really taken a massive leap in ramping up content creation and acquisition, knowing that in the future they will be in contention with Comcast, Disney, CBS Viacom, I imagine, will come up with a streaming service very, very soon as well. And AT&T with introducing Warner Media as a streaming service, although I think it's called HBO Max, if I'm not mistaken. As you can see here, media and entertainment firms take on quite a bit of debt. And they do this by also acquiring a lot of different properties. Now, aside from just acquiring things for them to show to people, if I acquire 1,000 TV shows, 500 movies, what does that do for me from a financial standpoint? What am I able to reduce? Risk. I am able to reduce risk because I have all these properties I've invested in. I have X-Men, I have Marvel, I have Mickey Mouse, if I'm Disney. In 2020, will all of those properties do well? If they don't, is it likely all three of them will do poorly? No. And so from a financial standpoint, just as you would with your own stock portfolios, you invest in everything. You invest in dramas, you invest in comedies, you invest in documentaries, you invest in action. You invest in horror. You do this because, again, you don't know precisely how everything is going to shake out. But as future media managers, you need to have a complex and sophisticated portfolio. When you have this, when your firm embodies this particular concept, you help insulate yourself from external factors that are outside of your control. There may be a year or two that, for whatever reason, people are just not interested in horror. Or maybe your horror intellectual property. People, for whatever reason, are sick of Freddy. They are sick of Jason from Friday the 13th. Highly doubtful, but it could happen. When we take on debt, we have to be careful about spreading risk. Because ultimately, that's what we're hoping to do here. By taking on this debt and investing in a whole host of different properties, we are able to better insulate ourselves from debt. Well, that's all the time we have on Late Night Learning. Keep laughing, keep learning, but also take a moment today and reflect upon the small miracle that is you. Tragedies like 9/11 are unpredictable, but leave an indelible imprint on all of us.